Welcome to our weekly market review brought to you by ETM Analytics and TreasuryONE. I'm joined as per usual by TreasuryONE's currency strategist, André Cilliers. André, we're taking a quick look back from last week. Not much going on apart from the US inflation data, which obviously was the highlight of last week's data. The inflation still ticking lower, but perhaps not as low as market expectations wanted, which of course then puts the Fed's next decision kind of, it's bringing it into question. Let's put it that way. We are obviously anticipating markets mostly 25 basis point cut. There were some hints of even a possible another 50 basis point cut coming, but that is seemingly growing less likely.
Yes, good morning. An interesting one, and I must be careful now because I'm criticizing myself because I'm part of markets. But there's a lot to say for the objectivity of markets. And we have, over the last 2-3 weeks, I've spoken about markets, getting ahead of themselves. And that objectivity, in inverted commas, objectivity by the market, is now really reflecting to us how much it's changed from we're announcing a 50 basis point cut by the Federal Reserve to jumping to conclusions that this is going to continue and we're going to see another 75 basis points. And then out come the new inflation figure, and out come more non-farm payroll data and so forth. And an interesting one, once again, the market expected 2.3%. It was, at the previous release, 2.5%. It came out at 2.4%. So the downtrend of inflation, my arithmetic says 2.5 comes out at 2.4 is still lower, but it's not what the market expected. And hence we had seen a jump in the currency, and a market that now said, okay, now they're not going to really do this, because also the unemployment data that came out was on the non-farm payroll side was a little bit better. So, now the Fed doesn't have to do anything, so I can also just step away from easing of interest rates now. So once again, the market getting ahead of themselves, trading on that, but we must please always remember that there's something called day traders. Billions of dollars going through the market on day-to-day trading. They live for figures. They don't think 2 weeks and 3 weeks and 4 weeks ahead. They just think, what do we do and what is the currency doing over the release of the figures? And then you see these jumps in currencies. If we analyze the figures and we look at the US economy, then that still says inflation is trending lower. Unemployment data, although the one figure might now be better, is there's still a slight upward tick in the unemployment rate. So there's still room for the Federal Reserve to cut. But I've warned against this, that they will do it at their own pace and at their own time. So the possibility of another 50 basis points just becomes slimmer and slimmer and slimmer. If we're going to see a cut at the next meeting, it will be 25 basis points, and they will resort back to movements of 25 basis points at a time. They will still look at growth. They will still look at trending inflation lower. They are still forward-looking, and that's how they will play this whole management of monetary policy.
And that obviously is a very big if they cut with that 25 basis point. You at the moment, the central bank making their rate decision likely to continue with their cutting trend again this week, with the focus of being more concerned about growth in the EU. We see, for example, last week, Germany's authorities, they came out officially saying, or they now believe that there might be another recession this year that came after they actually just expected a stagnant economy. So Germany not doing that great, which is obviously the engine house for Europe. And the ECB, of course, taking notes. And like I said, likely to continue with their cutting cycle this week.
Yes, of course, the European area is most probably, if we look at world economies, more of a concern, because those economies are definitely stagnating. There's no growth. There's no demand. Some of their industries, and I'm specifically thinking about the car industry, is in serious trouble, and we see profit warnings by the motor manufacturers on a continuous basis. So likelihood of them focusing on growth and getting growth back, hence they could become a little bit more aggressive in their cutting cycle, in trying to stimulate growth by cutting interest rates, getting rid of, be it low interest rates, it's still a high interest rate burden for companies with overdrafts and facilities. And they would try and work that lower so that those people do better and that you stimulate growth and that they avoid a very long-term recession. They're also definitely not as a closed economy as you would find in the US. The US normally does a lot better, even when other people is battling, than what the Europeans are doing. So we can expect the European Central Bank to be looking at their monetary policy, cutting interest rates, trying to get the economy going and, avoiding a very long and deep recession. And that's an interesting one, but we'll get to that just now when we speak about the Rand and what could happen to the
Rand. Before we get to the Rand, there's just another thing to point out that's coming out this week is, of course, China's GDP figures. We know the behemoth that is the Chinese economy is struggling to gain real economic traction, at least economic growth like we've become accustomed to over the past 2 decades. They're possibly finding themselves in a deflationary trend. But for anyone that is interested, actually, ETM Director George Klenos and myself had a big discussion on China. It is available also on our YouTube channel. But I am with the currency strategist. So I know the ZAR, the Rand had some support last week, which was a bit strange, but what's going on?
Yes, what's going on? Well, I started off by saying, when that inflation figure came out, we saw a dollar strengthening and a euro weakening and the Rand jumping up to higher levels again. And then just, we're back at the 1745. We were even below that a little earlier in the morning. So what's happening? Well, I spoke about the euro area. I spoke about possibly not such big movements in changes of interest rates in the US anymore. And that all holds up very well for a dollar that might not be in for this massive weakening that a lot of people anticipated. Because on the euro side, as we said, that economy is in deeper trouble than what is definitely the case in the US, and that could not bode well for the euro currency at all. And the same holds true for the British pound. Then when we look at the GDP of the Chinese that's coming out, that might also not be so well, which means that the world economy is still not really showing any growth. And that could keep the dollar on the front foot and add to that turmoil in the Middle East with the whole situation on the war and the impact of that on oil prices and the possible impact of that filtering through back to inflation rates, filtering through back to monetary policy, inflation rates, and filtering back through to monetary policy by central banks and the impact of that on growth. And we might be in for a bit of a surprise in the sense that even though there's a lot of positives that's actually holding up the Rand at these levels, like load shedding like GNU and so forth. We've spoken about this before. Our trade of terms is looking very well. Our exports are doing well. That means our trade balance are doing well. But these things might all come into a very mixed bag with what happens on international side with interest rates. And I think that's going to start taking a bit more of a leading impact on the rand. So we might not see this strength of the rand going on that long and
yes,
being supported by these local factors so long. The international factors will take over. So we'll have to watch the space very, very carefully. But at this point in time, we're still very comfortable in the 17 to 18 level, and one could narrow that down at this point in time. But there is a cautiousness that steps in from my side, and we know that this currency of ours can be very volatile. Now, I am not calling for a massive weakening. That's not what I'm saying. I am simply saying we'll have to watch the space very well, and we'll have to watch what happens with the value of the dollar very, very closely. It could have an impact on what we can expect out of the currency, or out of the local currency.
Yeah, as we get the last 3 months of the year underway, it really feels like we're entering into a lucky packet at this point in time. Between the US elections, between what's happening in the Middle East, between what's happening in South Africa, I mean, like you said, we're just going to have to sit back and wait and see what's going to happen for the last quarter of 2024. André, thank you very much.
It's a very interesting one. It's a very interesting 3 months. You mentioned the election. I had a phone call from a client of mine that asked me whether I heard about this thing that goes around of the equity markets in the US that will take a massive decline if Donald Trump wins, and the advice that's being given by some people that they should get out of everything that looks like equity. So interesting things that goes around. It simply says volatility is on the cards, and we must be careful of that.
Well, on that cautious note, André, thank you very much, and we'll see what the lucky packet has in store for us next week, Monday.
Thank you.